Okay, let's talk just a little bit, and we'll continue this next time, but we'll talk just a little bit about how does money affect the economy. Now, as there are so many things, we've all been working or interacting with each other out in the market economy throughout our lives, and so we feel really comfortable with this. The market economy is just out there where anything is being bought or sold, and so if you go to a vending machine and pump a few quarters into that and get a soda, you're in the market economy. So everybody's familiar with this, and we have this sort of familiar understanding, but it's not a real technical understanding of how that works. And so what we want to do, this is money and banking, we want to talk about money. How does money affect the economy? And we want to go beyond the old, well, you know how it happens. Yeah, I do know how it happens. I want to make sure you do. Okay? And so we'll be a little bit more technical than just, boy, if I got more money, I'm buying more stuff. That would be true. But that is not a technical analysis, and it doesn't really allow us to understand things in more depth. And so I always like to start off with an analogy, something kind of simple. And so let's start it off this way. Let's say you go home and you raise up your garage door and there are 5 lawnmowers sitting there. And you go, holy mackerel, I got 5 lawnmowers. I don't need 5 lawnmowers. I need 1. Maybe 2, one of them to do like close work around the shrubs or something like that, and one of them to mow the yard. I don't know. 1 or 2 lawnmowers is enough for anybody. If you've got 5, you got too many lawnmowers, right? And what do? Do you just say, well, I got 5 lawnmowers. Gosh, I hate that. No, you get rid of the extras. Well, you know what? Money is kind of that way too. Let's just say that, and whatever your expenditures are, maybe you're spending $1,000 a month, just to pick some number out. You're spending $1,000 month after month after month. And this is just how much you normally spend, is $1,000 a month. Then you probably start the month off after your payday and that sort of thing, paycheck. You start the month off, you got a certain amount of money in your bank account. And you got a certain amount of cash, you got a certain amount of money. And so for your $1,000 worth of spending during the month, you've got some amount that you traditionally need of money in the checking account, money in your pocket, cash. You've got a certain amount of money that you need to carry out the business that you normally carry out during the month. And it's the same thing as it is, and whatever that amount is, maybe you've got $1,200, $200 in cash and $1,000 in your checking account. Whatever the amount is, it's kind of like those lawnmowers. Suppose that you get your bank statement and it says you have $2,000 in your checking account. And you go, I got $2,000 in my checking account. But you know what? I normally only have $1,000. I can get through the month with $1,000. I got an extra $1,000. Now, we don't mean you've got an extra $1,000. You hate that. But we mean you got an extra $1,000 over and above the amount you normally need to carry on the life that you normally carry on. And this is sort of like having all those lawnmowers in your garage. And when you got all those lawnmowers in your garage, you're going to get rid of them. And guess what? When you got all that money, more than you normally would have, an extra $1,000, you're going to get rid of that. Now, I don't mean to say you're going to burn it up. I mean you're going to do something that's going to affect your behavior. And so when the amount, and this is not only true for you as an individual, but it's true throughout the economy as a whole, if we add everybody up. But when the money supply is greater than money demand, and this money demand is what is normally needed for what? Typical needs. When we have this situation of money supply is greater than money demand, economists have a term for that. What we say is that there are excess money balances. Excess money balances. And this is a little bit like the lawnmower situation. You got too many lawnmowers, you get rid of them. Now, how can you get rid of lawnmowers? Well, you could have a garage sale. You could donate them to charity. You could give them to neighbors. How do you get rid of money? Well, yeah, you could give it away. You know what most people do with it? They spend it. Right? Lawnmowers are just an asset. And if you got too much of that kind of asset, what you do normally, you have a garage sale. Put a sign out there that says lawnmower for sale. Somebody comes along and buys them. And what you're saying there is, hey, I had this asset, lawnmowers. I got more of that asset than I need. I want to trade that for some other asset. And the asset you, in the first instance, you trade that for is money. You sell that lawnmower. Let's say you put a sign that says lawnmowers, $50 a piece. You put 4 lawnmowers out in your front yard. People come along, here's $50, $50, $50. All of a sudden you got $200. So that's the asset you traded those lawnmowers for, is cash. And now you take that cash and go out and get something else. Maybe what you do is buy some clothes. Maybe you go to dinner. Maybe you go out to a movie. Maybe you use that to go on spring break. Okay? But this is just a matter, all of us have certain assets, and we're trying to balance those assets. What assets can I hold that serve me best? And the same thing is true. If you've got $1,000 of money assets over and above what you normally need and have to conduct your business, then this is just an asset that's out of balance. And so then what you say is this, gosh, I always wanted, I don't know, a new pair of jeans, or I always wanted to go to Florida on spring break. These are other assets that you want to have. And when you've got this extra $1,000, then your assets are out of balance. You've got too much money asset and not enough of these other assets that you'd like to have. And so when you balance your portfolio, you get rid of this extra money asset and you get more of this other asset, whatever it is, new pair of jeans. And this whole idea of getting rid of money assets and getting more jeans, we call that spending. Right? You just take some money out to the mall and buy a pair of jeans, and we wouldn't normally say, oh, that person has rebalanced their portfolio of assets away from money and toward jeans. We don't use that terminology. What we say is, I went out and bought a pair of jeans. And so when we go back to this, if we have a situation where, for you personally or for the U.S. as a whole, when money supply is greater than money demand, and again, I mean that by the amount of money we need for our typical purposes. When money supply is greater than money demand, we are out of balance with our assets. We've got excess money assets. And when we rebalance our portfolio, we get rid of some of that money in order to get these other assets. And so what we say is that there's an increase in spending. And this is the thing that stimulates the economy. How are we doing so far, okay? Kind of simple, isn't it? And I think, lawnmower, you could use anything else as, an example to illustrate this, but it's really not complicated stuff. We call this monetary theory, by the way. And, you can go to graduate school and study monetary theory and be the chairman of the Federal Reserve and so forth, but it really kind of comes back to these fairly simple ideas. Now, in the first instance, what happens, like on any given day, you might start off where money supply and money demand are equal. For you personally, you might say, oh, I need start the month off with $1,000 in my bank account and $200 worth of cash, and that's what I have. And then you just go about your ordinary business. When the Federal Reserve does something to increase the money supply, and we'll get into what it does later on, but when the Federal Reserve does something to increase the money supply, that's when we get these excess money balances. Money supply goes up. You start off with the equality here. Money supply goes up, and all of a sudden, money supply is greater than money demand for the U.S. as a whole. And that may not affect you in the first instance. Maybe money supply is greater than money demand, not your money supply, so you just go on about your business the way you've been doing. But when the Federal Reserve, if they put another $1 billion in the economy, somebody or many somebodies have got that $1 billion. And whoever it is that's possessing that $1 billion, for them there are excess money balances, and they get out there and start spending more than they were before. Okay, and so that's how the economy gets stimulated. Usually the way this works, and I mentioned a little while ago, is the Federal Reserve will do business with some bank. And so in the first instance, the Federal Reserve's putting that money in the economy or those funds at some bank. Some bank starts making loans. If you go to the bank, you get a loan. You know what they do with that money? If you say, I want to apply for a loan, I want to buy a car, $20,000, you're approved for the loan, you sign all the documents, then what? Then they say, we'll put that $20,000 in your checking account. And that checking account, that's money. And so that's where your money supply would be greater than the normal amount of money you need to do your business. And you say, oh gosh, I got an extra $20,000. And so what do? We go out and spend that. We buy that car. And now the people who are selling cars say, oh gosh, look at that, sales are up. And then the people who are selling cars, they say, gosh, we just sold some cars off the lot, off the showroom floor. Let's order some more cars. We need to get some more to replenish our inventories. So then they call up General Motors or Ford or Toyota, whoever this is, and they say, send us some more cars. And then General Motors or Ford or Toyota says, okay. And then they tell the workers, hey, make a car for us, or some cars. So now there's somebody else is being affected, somebody in Detroit or somebody in Kentucky or somebody in Missouri, someplace like that. They're making these cars. And so when we see this, and it's just too complicated to draw a picture, there are thousands and thousands of places this money could go, but this stimulus of the economy, this extra spending that occurs, it just goes to all sorts of places. And so that's how the stimulus goes into the economy. Usually what happens, and I just mentioned a moment ago, is when the money supply is going up, these banks are making loans to people. And you know, when banks make loans to people, it's usually for, I don't mean to say just one or two things, but a fairly narrow range of items. Like we don't go to the bank and say, I'd like to take out a loan so I can get a newspaper in the morning. I want to take out a loan so I can buy breakfast. I want to take out a loan so I can get a haircut. That's not it. We tend to take out these loans in order to buy a car, in order to buy a house, in order to buy a motorcycle, some big ticket item, a boat. Companies go get loans at the bank. But usually when these companies are taking out loans at the bank, they're trying to buy something like, oh, I want to buy a warehouse or a factory, or I want to buy some delivery trucks or whatever. And so when these loans are made and the money supply is growing and then we get this extra spending, the stimulus to the economy is not like more morning newspapers will be sold or more breakfast will be sold. It's not that kind of thing. It tends to be for these big ticket items. Okay, and so there will be something that happens like there are more jobs, let's say more manufacturing jobs, right? And then there will also be more demand for, let's say, energy. What do you mean energy? I mean that if cars are being produced, you don't just have a big factory that's producing cars without having a lot of electricity and things like that being used in that factory. And there will be demand for raw materials. Let's say demand for steel, if it's a car that's being manufactured. That's steel and tires and any number of other things. Now, so here are these more manufacturing jobs. Now we've got more people working on the assembly line, and they're putting these cars together. And then guess what? They get paychecks, right? And so then the guy or gal who's working on that assembly line, they get a paycheck, and then they go out and spend that paycheck. Oh, demand for groceries. Demand for clothes. Now, here's where this money starts getting into the general economy. So the Federal Reserve did something to begin with. Some credit was created, a loan was made. Whoever borrowed that money, you don't go borrow money just to see if you can borrow it. You borrow it so you can buy something. So now you go buy something Let's say cars. Okay, stimulates the economy. Here's the cars. And so that stimulates the car business, but now the people who are supplying things to the car business, services and commodities and so forth, they get that money, and now they're just buying everything. You know, car workers are sending junior to grade school. Car workers are going on vacation. Car workers are eating at restaurants. Car workers are just whatever you can imagine, they're doing this. And so a few steps down the road, or in our logical process, a few steps away, these dollars are entering the general economy. If there's a demand for steel, for example, here's a demand for energy, so people working at utilities are going to start getting money. And the people who are supplying coal to the utility companies are going to get money, and these funds are going to work their way into the economy. And so it takes time, but not a lot of time. Okay? Because if you come back and look at this, if the Federal Reserve increases the money supply today and provides funds to banks, and banks don't just sit around going, okay, we got a bunch of funds, that's fine. They don't do that. What they say is, hey, we got these funds from the Federal Reserve. You know, if we'd get busy and make loans, we'd get some interest coming in. And so they've got an incentive to get this money into the economy, and the incentive is the interest. And so when the banker starts making loans to people, people don't just take out loans for the heck of it. They take out a loan for a purpose. I want to buy a car. And so when people go out and buy those cars, it's pretty fast. And then when the car seller starts, you know, the dealership starts selling those cars, they're placing those orders. And it doesn't take very long for the car manufacturer to say, hey, we need this or that or the other. And so this money spreads through the economy fairly quickly, and I don't mean to say in a matter of a couple days or anything like that, but we're not talking about one of these days. Within a few months, that money is getting pretty busy in the economy. And we start seeing these effects down the road. Here's what we're seeing here, more manufacturing jobs. Employment's up. That's the numbers that we would start seeing that are released by the Bureau of Labor Statistics. Employment rose, unemployment's down. Eventually, this demand for cars, the demand for energy, the demand for steel, the demand for things, these people out here are buying groceries, they're buying clothes. This demand is eventually going to be putting upward pressure on prices. The people who are selling cars and clothes and whatever, all raw materials, those people are going to go, gosh, we're selling a lot more of our stuff, whatever that stuff is. We're selling a lot more of that than we used to. Let's raise the price. And so then we start seeing statistics. And it takes months for this to happen, but we start seeing statistics. Hey, prices are going up. Hey, we got inflation. The economy is expanding, jobs are being created, and now we're getting inflation in the economy. Okay, and so these things take time. The very quickest things that happen is the loans are made and people go out and start buying things with those loans. And I'm just using cars as our example. That happens right away, but with a little bit of a lag. You know, if people go out and start buying cars, the first thing that happens is we're buying inventories. Those cars are already in the showrooms, they're already out in the back lots at car dealerships and so forth. So there's not a lot of jobs created that day. But once those inventories get depleted, that's when those manufacturers start hiring more workers and start increasing production. So after a few months, we start seeing more jobs and seeing unemployment go down. And then several more months, we start seeing the inflationary pressures, the prices going up. Just to give you a ballpark number in terms of how long it takes, we're talking of around, money supply goes up today through this process of banks making loans and so forth. We're talking of about 6 months until we start seeing the jobs appear. Okay, sometimes a little less, sometimes a little more, but around 6 months. Could be 9 months. And until we start seeing the inflationary pressures, the prices going up, and we can see sort of the leading edge of it sooner, but in terms of how long does it take for this to really kick in, a year, year and a half, sometimes as long as 2 years. Sir?
So do you think inflation will hit us about 6 months after the stimulus package?
Right now? No. Because what happens is, you know, if you have a lot of people that are looking for jobs, you know, and there's a lot of companies with a lot of inventories and they're trying to sell them, then they're just so happy when there's more spending and willing to go to work without a pay increase. Like, okay, I'll take what you're offering. And the people who have all these inventories that they haven't sold, they're willing to sell that, like without raising the price. They're just happy to get rid of it. And so if you have more slack in the economy, as you do during a recessionary period, more slack in the economy, then that doesn't feed through to recession or to inflation nearly as quickly. But, I mean, if this persists, if you just keep on increasing the money supply more and more rapidly, then there will be a day, and how long, it depends on the particular situation. And that's why I said a year or two. There will be a day when that leads to inflationary pressures. The Federal Reserve, in the present instance, the Federal Reserve has said we're going to increase the money supply, but when we see the economy start to respond, we're going to take some of that money back. And so they're not just going to keep on increasing the money supply and say, hey, let's see what happens. They know what will happen. So what they say is, hey, the economy start moving. We're seeing more spending. We're seeing some jobs. Now it's time to start pulling some of that money out of the economy so we don't get a lot of inflation. At least that's the theory of it. And if they make a mistake, then, yeah, we're going to get inflation. But, I mean, that is where the inflation comes from. If you think about this money thing is very important to causing inflation because let's just say hypothetically that the money supply did not go up. The Federal Reserve doesn't do anything. There's no increase in the money supply. And let's just say everybody that's got something for sale says, let's increase the price 10%. Let's increase the price of bread 10%, price of cars 10%, price of newspapers, chili, just whatever it is, 10%. Well, they're all doing this. Where do we get the money to pay for that? I only have a certain paycheck. You have a paycheck. You go out and you want to buy stuff. And if everybody's increasing the price 10%, I just can't buy all the stuff I've been buying. And you can't buy all the stuff you've been buying, and neither can anybody else. And so the people who are raising the price 10%, they start getting disappointed. Gosh, I raised my price 10%. Now I'm not selling as much as I used to. I guess I shouldn't have done that. Now, if we had an increase in the money supply, and I got 10% more money in my pocket, and you got 10% more money in your pocket, and the next person, we all got more money in our pocket, and then the people who sell things are raising the price 10%, I can still afford to buy all that stuff, pay the extra 10% for that stuff, and I can still buy as much as I used to. So you've got to have that extra money in the economy for prices to go up and for that to stick, for prices to go up and persistently go up. For us to have inflation, there's got to be more money in the economy. And if we don't have the money supply accompanying that, we have prices go up and then a bunch of bankrupt companies, and then prices start coming down when they put everything on sale. So money is an essential part of this inflation story. Anyway, so what I'm saying to you is this, is that what happens to the money supply? If there was an increase in the money supply, it's not like, well, everybody spends money. Yes, they do, but there is a chain of logic that you need to follow in order to sort of figure out what's going to happen, and that way you don't go, I don't know, somehow or another the price of chili will go up. How is that? At what point? What would cause that? And the answer is way on down the road with the price of chili. Much more likely that if the money supply goes up and there's more credit, people are buying the big ticket items, and we start seeing the stimulus there first. Okay? And then we start tracing this through. And so there is this process for us to follow. And then where we see all this, we don't see all this in one place. We're talking about the concepts here. Economics class, we talk about the concepts. What we do see, though, is that we see these reports coming out from, let's say, the Bureau of Labor Statistics. Employment is up, unemployment is down. And we see an inflation report that we don't see something, demand for clothes up. What we see is, hey, the price of clothing is going up, the price of food's going up. And so, gosh, I wonder why those prices are going up, because of the extra demand for those things. And so we're seeing economic data that reflects this underlying process. And this is basically how this money works its way into the economy. And this is why it's so important for us to understand this. We start off with a situation where money supply and money demand are equal, and both for the average individual and for the economy as a whole. And for us to understand what's going to happen in the economy, we have to start paying attention to what's happening basically to the money supply part of the story. This usually, money demand, is not very, it doesn't fluctuate wildly and so forth. If you start off saying, oh gosh, I spend $1,000 a month, I need about $1,000 at the beginning of the month in my checking account and $200 worth of currency, that's more or less the same month after month after month and could go on indefinitely, right? But what can change at a moment's notice is the Federal Reserve can get in there and do something to the money supply and it can upset this imbalance. Let me close by saying this. It's not always the Federal Reserve increasing the money supply. What if we've got an equality here and the Federal Reserve decreases the money supply? Then we'd have a term where we'd say not excess but deficient money balances. And if we have deficient money balances, here's what that feels like. You normally start the month off with $200 worth of currency and $1,000 in your checking account. That's normal. And though the mail carrier comes, you get the mail, you open your bank statement, and it says you've got $800 in your checking account. And you go, oh my gosh, I've got $800 in my checking account. How am I going to get through this month? And somebody says, hey, let's go out to dinner tonight. And you say, I can't afford it. Hey, let's go to a movie. I don't think so. Hey, let's go get a new pair of jeans. No way. I'll wear the old ones. And so when the money supply goes down and we have deficient money balances, money supply less than money demand, then what we see is this whole process is reversed. Spending decreases. People are saying, gosh, I got to do something about this situation. I'm out of money. Spending decreases. There aren't as many jobs. There's not as much utilities sold. There's not as much steel sold. And you can work your way through the process. The auto workers are not working overtime. They're not buying new clothes and they're not going out to dinner and so forth. And it works its way through the economy that way. And so it's very important for economic conditions. You know, I know as individuals in the microeconomy, we know that it'd be nice to have more money. We know it'd be bad to have less money. But what I'm saying to you is that this same little story that we as individuals feel playing out on a day-to-day basis, the overall economy feels that as well on a macroeconomic level. That's it for today, and we'll go on next time, talk about this, and get into the next chapter of material. So long.